Hey investors, welcome back to Vishal Vealth View. I'm sorry for not uploading a video for past few days because I was taking some time off and I'm back and I'm taking a look at my portfolio and it looks in red. So in this episode, I'm going to take a look at my stocks portfolio and reanalyze or reassess whether I need to change some of my investment or do I need to increase the risk appetite at this time. There's a lot of word that's going on that this might be one of the biggest correction after 2020 COVID crash. Now, a lot of investors are pessimist about it, but I want to be an optimist because this is a good time to buy and build new positions. So from this levels as well, there are market pundits that are saying that market can fall down even by 5% or 7%. So going all in might not be the best strategy with your cash at this moment. So taking it slow and investing your money over a period of 5 to 6 months would be a better strategy. And that's what I'm thinking about. So let's see what I'm changing in my stocks portfolio. Before starting this video, guys, this is not going to be an investment advice for you. Please do not invest in your money in any of the companies that are discussed here. Please do your due diligence before investing your money in any of the financial assets. So the current value of my stock portfolio is almost 49 lakhs. I'm sitting on a loss of almost 6% right now, and the invested amount is almost 52 lakhs and 57,000. So if you take a look at my portfolio, the diversification looks like that majority of the money is in small cap and to some extent others. I don't know what this other means, but they're saying that 21% is in large cap, while the community is keeping almost 42% in large cap. So I'm aware that this portfolio that I have created is really focused, and I only keep companies that I track pretty well or I'm able to understand pretty well. And I don't try to invest in companies which are either really big and I don't have a deep understanding of their like business. So let's take a look at the portfolio. I don't know how they're giving me this forecast of 54%. And it's also like on the current value of 16 lakhs, which is all the stocks that they are tracking. So let's talk about my first investment. My first investment is majority of the holding is in a index-based momentum strategy, which is investing in large and mid-cap companies. Now, this index is highly risky compared to Nifty 50. As you can see, Nifty 50 has corrected by almost 15% by now, and this index has corrected from a peak of almost 38 to 28, so almost 30%. Now, the strategy of creating this index is let's invest in companies that has given most amount of return in past 1 year and 6 months. So obviously the correction over here is going to be deep because the chance of forming bubbles in this company increases. So right now I'm not taking any money out from this investment and I'm comfortable holding this investment because I do not see India entering into a structural bear market for a period of 2 3 years. And I am expecting the growth to pick up probably in 1.5 year. And I'm holding this from a point of view of retirement and building long-term wealth. And I think I should be able to generate more returns uh, than Nifty 50 using this index. And if I just do dollar cost average. So that's my strategy over here. In the second investment in Kotak Nifty, Alpha 50 and Mirai Asset Small Cap 250 Momentum Quality Index, both of them are also index which is created on the basis of past performance of the stocks, and they do not highly care about the fundamentals. This index do care about the fundamentals because it also takes a look at the quality aspect of the companies, and this is only investing in small cap 250 space. So selecting 100 companies out of 250 small cap companies that are giving the major returns and have best fundamentals. So again, this is a long-term dollar cost average strategy for me. So I'm not going to just pay too much attention to the correction, and I'm just going to keep on continuing the SIPs and uh, my regular investment because this is a good time to just dollar cost average all of these positions. So almost fourth biggest position and almost 10% of my portfolio is in Sunteck Realty. Now I built this position almost 3 years ago or 2 years ago, and this has not generated any return. So let's take a look at the company fundamentals and what's the story of the company. So this company is a real estate developer in Mumbai, and they are only focused on developing real estate in Mumbai. And recently, they have acquired one project in Dubai, which is worth almost 9,000 crore, and they are planning to deliver it by 2027. Now, it's a good thing and a bad thing that they're only focused in Mumbai because Mumbai is a high ticket market and the cost of an apartment is such that you can maintain a good margin if you don't pay for the land and if you can just uh, have a JDA with the landowner. And that's the strategy that they have been following. Now, if we see the performance of this particular company in past 5 years, it has not generated any returns in last 5 years. And if we see what's the earning per share trend uh, over over the over the course of COVID, the EPS decreased almost to zero, and now EPS is coming back up. And they're also saying that by 2027 they'll have almost 5,000 crore of rental property that they'll own, and out of which they can generate almost 300 crore of rent per year. So if they're generating 300 CR of profit before tax just from their rental properties, and let's just forget the other income that they're going to generate from the apartments that they're going to sell, I think this is a good time to invest in this company for me. So even though the performance for my investment over this company has been negligible, I am building more positions in this by taking some money out from the investments in Nykaa because I the risk over here I see is relatively less. The debt, the company is almost sitting on negligible debt. The cash reserves uh, for the company is high. Almost I'm buying it at point 0.5 uh, like rupees. And another interesting thing is going to be where is the growth coming from? Now the growth is only going to come from the new cycle, the consumption cycle that might start where credit would easen by RBI, the rates will decrease and people will start buying more home. And that's where I see Sunteck might be able to generate good growth in next 2 to 3 years. So for me, this particular company both has a value and growth aspect included in it. Their pre-sales growing by almost 50%, which demands a better P than 27.5 as it's trading right now. So uh, in last few weeks, I've been investing more in Syntech. Now I can understand that this might be a uh, I might be over investing in one single company, but uh, I think this is my personal portfolio and I can do whatever the fuck I want to do with it. So let's see if we fail over here, we'll learn a good lesson. Otherwise, we are not going to make good money until unless we go big. So next we have is Motilal Oswal Nasdaq 100 ETF. Now this is a ETF that invests in 100 companies listed in US which are non-financials, and that specifically include tech and other service-based company. Now, 50% of the composition of this index is in tech companies like Nvidia, Meta, Netflix, Apple, Tesla. And I'm using this as a way to diversify my investment into US market. Now, I wanted to keep my investment in this approximately 10 to 15 or 20% of my portfolio. Now, this uh, particular index over the past few years has given a lot of run up because how the global situation is changing. But I'm not going to care about that. For me, right now, this is looking in uh, a bubble slash euphoria kind of territory. I invested in this particular index during the time of early 2023. And that's why the amount of return I'm sitting at on this investment is almost 100%. Now, the mistake I made was I could have done an SIP over the period of 1 or 2 years, so I would have generated more returns on the capital that could have been invested over here. But I did not do it, and that was a mistake. But now I don't think this is a good time to build more positions, fresh new positions in bulk, at least over here. If I have, if my portfolio is structured in that way, that over time op- my positions in Indian equity just goes really up because Indian market has given a lot of run up. At that time, I might take some money out from some of these investment and reinvest in this index. But right now, I'm not planning to put any fresh new money in Nasdaq 100 at all. Okay, I'm not enjoying ticker tip experience, so I'm switching back to grow. Next we have is Varun Beverage. Now this is a really long story for me. I invested in this company and I think 2022. No, these are not investment, these are just split shares. When did I invest in this? I think I invested this in this company in early 2021, and since then it has given me a good amount of return. If we see the amount of return I'm sitting on this investment is almost 200%. Now, when this company was trading in August 2024, at that time, I did not think it was a good time to buy this. And now I also don't think it's a good time to buy this company because there's clearly a euphoria slash overvalued zone that exists in this company. Now, if we see the fundamentals of Varun Beverage, now, this is almost a $20 billion company, and it's trading at a valuation of 62, which is stocks PE. The ROC and ROE number look good. It's on a decent debt. I think it's manageable. They should have this much amount of cash reserves. And correct, like obviously the stock is in correction phase right now because to some extent it was overvalued at the PE of almost 90s and 80s. So clearly, it was not a good time to invest in that company. The question is whether it's a good time to invest this in this company and build fresh positions. Yes or no? So we see 1 year median PE, it's trading below its 1 year median PE. But if we see the 3 year median PE, it's still trading around or around that range of its 3 year median PE. Now, stocks behave in uh, stocks do not follow logic. They behave on the basis of emotions of investors. So when the stocks go up, it goes into euphoric zone first, and when the stock corrects, it will go into depression zone. So the best time to buy individual stock is when it's in depression zone. I don't think this particular business is in depression zone or the stock is in depression zone right now. I think it's just might be correctly valued right now. So if we see other companies against which we can compare this company, which is Hudson Agro, Bikaji Foods, the growth prospect of Varun Beverage is obviously better than all of these companies because there are they're a bottling business and they're entering into new domains like milk and also energy drinks. But again, the PEG ratio remains over one. So clearly, we can say it's an overvalued investment, which can assure consistent growth over a period of 10-15 years. Next we have is Tips Music. Now again, this is a music label company that purchases music and produces music, and the revenue that they generate is usually from YouTube, streaming agencies like Spotify, Ghana, Amazon Prime. Now, if we look at the fundamentals of this company, it's almost $1 billion company. It's trading at a valuation of 60. It has a ROC of 104 and ROE of 80. That means the company is clearly able to employ its capital and generate good return on it. And the PEG ratio is around 0.38. Now, from all the aspects, from debt point of view, from growth point of view, and also from the ROE point of view, the company has good fundamentals. But the valuation, again, it's on expensive side. Like whenever you're buying any company above a PE of 2025, you need to have a good reason why does this investment is going to generate above average return or sales over a period of next 2-3 years. Now, if we see the stock is clearly in correction phase, there was a euphoria in the market in October 2024, and now it's almost going below its 230 DMA. So it might be good time to build fresh positions in this for at least existing investors if they are sitting on it and their investment have corrected. And over here, I'm planning to take this investment up to 3 to 4 lakhs. So I have 1.5 lakh uh, more to invest in this particular equity over a period of over this year. So I'll be investing this amount over certain intervals, maybe see if market corrects more and this investment corrects more, and if I have any buying opportunity. But that's the strategy in this company. I'm not changing or taking out money from this investment yet because I think this is a good long-term structural story in digital arts media. Next we have is HDFC Bank. Now, I have invested in this company almost 2 to 3 years ago, and this investment has not generated any return over the past 5 years or 3 years, I would say. Now, this might not be a bad thing because this investment is really less volatile, and whatever money I'm investing in this company, I do not expect it to be correcting by 30% or 35%. If that's happening, the entire market will be fluctuating a lot. So it's a good liquid investment for me, and I am also expecting a growth of uh, 12 to 15% in this particular company's sales over a period of next 2 to 3 years. So whenever I am in a cash crunch or I want to build new position in any companies, I might take out this investment. Otherwise, I'm going to just let it sit uh, and grow the way it's growing. Next we have is Ujjivan Small Finance Bank. Now, I think I've also made mistake in this company and how I invested or how I played out the story. So I started building my positions in August 2022, and I completed my position, building my position by Feb 2023. And since then, the s- stock gave a good run up to almost 50-60% return on my investment by November 2023. Now, this might be a good time for me to exit, but I did not do it. And I held on to this investment, and now it has corrected by uh, almost 30 to 40% once again. Now, I'm sitting on a loss. I'm not planning to add more position in this bank. It's giving me decent dividends, and I'm happy with those dividends. And I think this still is a value buy. So as the credit cycle just turns, people start uh, taking more loans because the credit becomes cheaper. I think this stock can go up once again, and I might take out all of this investment that time. But I don't see this business growing at more than a pace of economy, and that's why I'm a bit skeptical in being a long term investor in this company. If we talk about Anant Raj, it's a $2 billion company, and it's trading at a valuation of almost 45 right now. And if we see, this is a primarily a real estate company which is venturing into data center business. Now, as per the current status, the company has already operationalized its 7 megawatt data center in Panchkula, and they're planning to expand it to 307 megawatt in next 5 to 6 years. Now, the story of the company looks uh, pretty weird. There was a demerger in, I think, around 2019 or 2020, and since then the company has been growing pretty consistently in its real estate business, and over past 2 3 years they're thinking about venturing into the data center business. Now, clearly the company was in a euphoria in the month of 2024, and sorry, in the year 2024 2025, and that euphoria just faded away with the release of DeepSeek and cheaper LLM models by China. Now, I think that entire story might not affect the business of Anant Raj as of now because they are just expanding into data centers. And India has a lot of demand and lacks capacity like hell. We are like the country which is producing, which is one of the largest data producing country in the world, and we are one of the country that has the least amount of data centers. So the growth opportunities for this company is huge over 5 6 years. The question is whether we are buying this at right valuation or not. Now, I think this company is still viable in my opinion, and I would like to invest more money in this company over a period of probably 3 months, 6 months. And the maximum amount of money I'm planning to invest in this company is 10% of my this portfolio, which is going to be around 4 lakhs. So probably 2 more lakhs to go in 3 to 6 months. And I'm going to wait and watch when the correction is happening and probably buy in when the time's right. Next we have is Fang 100 ETF. Now, this investment is actually a collection of just 10 companies, 10 best tech companies in US, and they just invest the in this index in an equated format. That means 10% of Tesla, 10% of Nvidia, 10% of Amazon, 10% of Apple. And honestly, I should have started an SIP in this because the investments are growing at a pretty decent rate. And I don't know. I'm not planning to bulk invest in in this index right now, but this might be a good time for me to learn to invest some amount of capital in this over regular intervals. Why not bulk investing? Because I think the entire tech sector in US is a bit overvalued, and I was investing in this index when it was in its correction phase. Around let's see, when did I invest in this? So 16 November 2022, and then I also built some position in Jan 2024. So Jan and June 2024. So clearly, I was an early investor in this, and the run up has been huge in this particular index over the past 1 or 2 years. And now I think it's clearly in an overvalued zone, and I would like it to go through some correction before I just start investing new capital in it. So I'm not going to sell this investment because the total portfolio that I'm owning in US equities is around 5 lakhs, which is around 10% of the total portfolio. And I think I'm fine with that level of diversification in my stock portfolio. Last we have is Nykaa. Now I'm selling Nykaa, and the reason is I don't see uh, organic growth coming, and I also see the competition increasing in the market. So let's see what are the financials of this company. How does the financial of this company look like? So this is almost a $5 billion company with a PE of I don't know what. And I invested in this company almost after 1 year of its IPO when this particular company has corrected a lot. So I was a investor in this company in almost June 2023. Now, over last 1 or 2 years, this company is not growing at all in terms of stock price. In terms of sales, the company has been able to double its sales by from 2021 to 2024. Now if we see the sales number for this company, the growth has clearly been coming. The sales has almost doubled in last three and a half years, and this primarily coming from their expansion in physical stores in tier two cities and expanding more stores in tier one cities. Now, still the margins of this company is around 5%. Clearly, I understand that they're in their growth phase, but I am always worried about the depreciation component that exists in this company's balance sheet, which makes the EPS look almost negligible. Now, until unless the company is able to generate decent profit, it's not able to reinvest these profits in growing in its business. And until unless that cycle comes into play, I highly doubt that this business will be growing organically. Now, I'm primarily worried about the competition that's coming into this market. There have been launches like K by Cora or Tiara. Sorry. These are the new competition. I think Purple, K Beauty, and Tira. These are the recent like investments that's coming into the BPC space, and I think Nykaa might have good hard time in the future from these competitors because big money is also coming into this business now. So I don't see how they're going to generate organic growth. The PEG ratio also looks really high because they're not able to increase their earning by decent margin. Now, if you see the cash flow statement for this particular company, it clearly indicates that they are in a spree of buying more fixed assets, and that's coming from their expansion of physical stores in all of these areas. So the physical footfall can convert it into customers and finally customer retention. So, based on the current competition that's coming in, specifically from Reliance, and the reviews that I'm also getting from, let's just say, my friends, that they don't use Nykaa that much because the products don't have good quality. I'm worried that all of this growth is just coming from expansions of physical stores, and this growth might not be sustainable over long term when the competition just pushes better quality BPC products into the market. And because of that reasoning, I'm planning to just take my money out from this investment right now, and probably reinvest this money in Sunteck Realty, because I think the growth prospects over there over next 2-3 years are looking in a better way, and that company also has relatively lower debt. Uh, Along with this, I'm also concerned about the margins of this business. Now, I consider both Sunteck and Nykaa as a consumption-led business to large extent. Even one is in real estate, one is in BBC, but both of them are to large extent fed by consumption. If people are able to get cheap money, they are going to buy more apartments. They are going to spend more money on BPC product because they have more disposable income on them. Now, this company operates at a margin of 1%, 6% right now. And Suntech operates at a margin of almost 20 plus percent. Now, their growth strategy is that, hey, we are going to take our profits and we are going to buy more rental properties in Mumbai. That's going to generate continuous, continuous cash flow for our business. And their strategy, however, relies a lot on advertising and expansion. So, from that point of view, I think keeping my money in Suntech might be a better decision than Nykaa as of now. That's it for today's episode, guys. I hope you enjoyed this video, and please do hit the like button and subscribe to this channel. Bye bye. Happy investing.